All right, the market started off a really important week, really quiet. Stayed in a very small range throughout most of the day until the very end of the day, where we kind of broke out on a relative basis, but at least broke out above the average range and ended up with a pretty decent move by the end of the day. Nothing too big, nothing too exciting, but at least continuing the winning streak that we've been having since really a few days before the options expiration. Again, going into the beginning of earnings season, I'm going to break down kind of the patterns we're seeing. These kind of renewed bullish breakout patterns that we're seeing. Again, without a consolidation, like we never really have consolidated that parabolic move. We've only converged for a brief period of time without necessarily consolidating. I'm going to compare another a period of time to today where we had a really strong trend at a very similar time frame of the year, as well as a very similar environment in terms of a macro environment, where, you know, with the Fed and what they're doing and ending their rate hikes and starting to prepare markets for a transition for rate cuts. So I'm going to go back to another time in the markets where we had a very strong bullish trend during a very similar period, and just kind of show you what happened there and what we expect will happen this go around. Take a look at kind of a bigger scale, how things are happening, not only on a sector level, but on a country level. And then that will take us into our trade idea of the day. A stock kind of really breaking out, on an international stock, really breaking out in an area that's been really lagging and underperforming the U.S. markets. We'll talk about how to trade that stock. So let's go ahead and get started. Today is Monday, January the 29th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog here, check out some of these other things over here on the right. Come over here, click the Market Outlook Live. This is where I review all the trades from past videos to see how they're doing and how to manage them. Come down to the bottom, click this heart. It opens up this tab. Click that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask for the likes and the shares and the comments and all of that. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. Nice start to a really important week to this week. A lot of things on the docket. A lot of you mostly know a lot of Magnificent Seven earnings out this week. Economic data, the Fed, the jobs report by the end of the week. So big week. And we started it off almost with a cluster. You can see the momentum line at the 73rd percentile down there, the near-term line to the 79th percentile. So those two, that's how close we came to finishing with all four lines above the upper reversals, above the 80th percentile. We came really close on the day before expiration. And we've gone up now after expiration, 1, 2, 3, 4, 5 out of the last 6 days. If you count the days before expiration, 1, 2, 3, 4, 5, 6, 7 out of 8 days to the upside. Nice, good move. As you'll see, it's producing a pretty strong patterns from a technical standpoint. Up to 49.29, again, well above not just 52-week highs, but all-time highs. Really pushing up. Now, that's not necessarily the case for RSP, which is the equal weighted. The equal weighted index, you can see 158.60 is its highest of the year. 158.41, 158.46 is the highest close of the year. If I were to go back to that same 2021 time frame here, you can see right at the very beginning of the year, the highest close was 164.20. So we don't have all-time highs in the equal weighted, and then the all-time high is 164.90. And again, we're at the highest high we've had here is 158. So we're not quite there on an equal weighted basis, though. On the cap weighted, of course, considering these mega cap names just keep getting bigger. They're leading the charge, as you would expect in a cap weighted index. That's actually what's supposed to happen. If you're going to be bullish on a market cap weighted index, if you're going to be bullish and the index is going to go higher, it's generally the leaders that lead that take us up to the upside. The Russell 2000 also had a really good day today after kind of languishing the past so many days. Coming down from the opens every single day, filling in every single gap. We did rally back up today, close above all those highs, and the near-term line crossed back above the intermediate line today. So that's a good bullish move back into the bullish territory. Not in the upper reversal zone yet, so we kind of need to hold this breakout back above the 23. Well, actually, we stayed above the 23% line for most of these 4 days. Those we were flirting there with another bull tag on the intermediate line there. But everything okay. Everything's holding up okay on the Russell 2000. Of course, your NASDAQ 100 is the index that's really driving this. It did not come close to a cluster. The near-term line is actually a lot lower, barely coming out of bearish territory as we're bouncing off of this bullish intermediate confirmation signal down there. Again, for those who don't know, the intermediate confirmation signal is the intermediate line in the upper reversal zone with the momentum line bouncing out of oversold territory, and ideally you want the near-term line in bearish territory, if not below the 50th percentile. And so we had all three of those on Friday, and that bounced back out here today. Your Dow Jones Industrial Average has also been very bullish. It did get a cluster on the day before options expiration, or the day of options expiration. The near-term line's up in the reversal zone. Again, the intermediate line is up above the market sentiment line, which is an important deal. The SPX, you can see, we were flirting with being below it. It's back up above it, back above the 90. Remember how we were above the 90th percentile for so many days in a row? Well, here we go again, right on another extended run, more than 2.5% above the 30-day moving average, being up over 3% right now. You also have gotten another bullish candle, Hakanyashi candle. You can see it's not a very strong candle. It's not as strong as we were early in the trend, but a higher high, higher close. That's a good sign. There's 6%. The PPO is up to 6% now, higher than it was back over here. So really ramping up. For some context on how strong that 6% number is, right here, this PPO where we're at right now, you can see, again, it's about as high as we were going into the COVID declines, about as high as we were going into 2018, early 2018, when we dropped there. And you can see some other peaks along the way, right about at the 6% level. Of course, in 2021, when inflation was really taking off, we were a little bit higher than that. We got up to almost 10%. But needless to say, this is a pretty strong level for the gap between the 10 and 40 week moving averages. Of course, no red arrow, no signs of weakness. Yeah, the only sign of weakness is a little bit of this green line potentially crossing. It's still slightly above the purple line down there, which is the average, 3-day average of the green line. But nothing and the divergence that we're getting here. But really nothing too concerning in terms of immediate. Remember, this is a weekly chart, so it takes weeks for things to move down there. Looking at the 3 green arrow chart, okay, not surprising to see, 3 green arrows across the board on the S&P, on the Qs, recently on the diamonds, and then even more recently today on this IWM. So we did have 3 green arrows for a day before, too, over here, and then we got back down below the moving average. So we haven't had 3 green arrows again, except for like 1 day sporadically here. So let's see if we can hold on to it like we did all these others, where you got 3 green arrows and you stayed green for a while on all those other indexes, ending pretty long periods of convergence for the S&P and the diamonds. This is what that convergence period looks like on the 2-line version. Again, the MACD is above, like here's that convergence period. The MACD is back above its moving average, as we're easily above the 17. IWM, remember, was kind of flirting with the 30-day moving average and flirting with the 17, but now clearly back above both of those as it's making a run up to the upside. The Q is obviously even more bullish than those two, than the Russell, and then your diamond. You can see it's been the most bullish out of all of them, as the MACD never did get even close to 0. And the stochastics barely dipped its toe below 50 before ramping back up above either of those lines. So very strong gap between the moving averages, probably more so on the diamonds than even on like the Qs, but so far not threatening to fill in that gap as of right now. Diamonds, I told you about these breakout patterns we're getting again. Here's your diamonds. I mean, we're back up to 40 on the positive indicator down there. We're back below 15 again on the negative. So pretty strong bullish levels again. It's brought the ADX back above 30 itself, back up to 32. So that's a strong reading. Again, not parabolic because you have to get above 40 for it to be parabolic, but needless to say, it's a strong rally. Good chance we can get there on the Qs because we did get above 40 on the positive indicator there. Not necessarily the case in IWM still. We're above 25 and we're dropping below 20, but not a big enough gap between these two lines to get the ADX to actually turn higher. We need a little bit more follow through on today's move. The Ichimoku trend, you can see we eclipsed 14. We're kind of breaking every couple of days up to a new level. Let me give you some context on just how strong that level is. Let's go out to like 2,000. So there's 14. You can see it's not too often that we get a stronger trend than that. You can see going into COVID, coming off the fourth quarter 2018. That's how bullish we were in the first quarter 2018 when we rallied there. There's the move coming off of the election of 2016. And then that's about it, right? They can see we did have a rally in 2006. Interestingly enough, the same thing that drove that rally is driving this one. The Fed is done raising rates. Now, they didn't cut rates until September of 07, or in this area, August, September of 07 is when they finally cut rates. But again, you can see we had a kind of a parabolic move there in 2006 as a result of the Fed being done raising rates and shifting towards an easier policy. To give you an idea here, during that first couple of months of 2007, you can see how many people were expecting Chairman of the Federal Reserve Ben Bernanke, the Federal Reserve Board CEO Janet Yellen, Fed Chair Janet Yellen. I mean, that was a popular thing back then during that time frame here when we were so bullish to be looking for a soft landing. Of course, a year later we were flat, right, at best, and then we kind of in the middle of a correction that ended up starting the bear market. But remains to be seen if that ends up being the case here. But again, you can kind of see, the markets really do well at the beginning stages, at the end stages of the Fed cycles, right, of these rate hike, rate cut cycles. In this case, a rate hike cycle, similar to 2006 when we were at the end of a prolonged rate hike cycle. It was actually 2 years there, where it's more like 18 months during this, about 17, 18 months during this cycle. So if I were to go back now and take a look at some of the other oscillators here. So let's look at the RSI and the CCI. Again, above 75 on the S&P. That's a strong level. The weekly CCI has turned back up slightly. It's still above 100. Now the weekly RSI is above 70. Again, last time we saw that was at the end of 2021, going into that period, also right before COVID. If I were to go back even further, it's pretty. You can probably tell me all the times, right? 2018. All these periods. Again, 2006, we saw it again at the end of the year. RSI got up to this level again during a move off of a rate hike cycle. That was actually not an election year, it was a midterm year. 2006 was a midterm year. 2007, of course, was not. 2008 was the election year, but so we're not in that same cycle there. But again, you can see how, again, overbought we were then compared to similar patterns we're seeing right now. If you take a look at the Bollinger Bands and the Keltner channels, we are in the upper quartile of the bandwidth, and we are outside of the Keltner channel again. So very strong move. We've been outside the Keltner channel now since the day before options expiration for all of last week, and now the beginning of this week. The momentum line again back to green dots. Did not produce, again, we haven't had a bearish momentum here for a while, as really since that October 27th. In fact, if you look, it's been 62 days now since the October 27th low point, that low point right there. So 63 is a full 3-month period. So we're just 1 day away tomorrow from a full 3-month period, and here we are now at what we ended up at 19.68%, so almost 20% of a rolling 3-month return. Again, and that's a pretty high. I mean, coming off COVID, it was about the last time we've been that bullish. coming off of that COVID low point where we were down at 1.30% over 3 months. You can see again coming off of the 2018 low. You can see coming off the bear market low where we were down again 20+% over 3 months. To kind of give you an idea, the low point that we just had was almost 9.8% for a 3-month period. So hardly a washout move, and yet the rally has been very much like a bear market low point, or a very strong peak in volatility that produces this type of rally. So big move. Of course, the hull is continuing higher. You can see at the daily chart, even though the size of the candles keep getting smaller on the weekly basis. So I showed you the size of the candles there, and you can see now the distance away from the 200 week hull, is as high as it was at any period in 2021. So again, we're in the 95th percentile of the past 5 years. If I were to go out to the past 20 years, not so much because of the bear market rally. But outside of that bear market rally, again, early 2018, we weren't this bullish. 2013, when we're right in the middle of QE3, we weren't this bullish. So needless to say, this has been a strong 3-month period as we're heading into a very pivotal earnings season that we either build off of this return or we start to take some profit, so to speak, on this return. Here's the 4-week range. You see how high we are. We're at 99th percentile, the 4-week range. The average is still above the 80th percentile, has been above the 80th percentile for a good period of time here, continuing to move higher. Let's take a look at the intraday chart. We did get a new high at the end of the day today, a nice little move at the very end, pushing us through, getting us. Now you can see that the size of the channel has gotten up to almost the 5th percentile, 5.08. So we're just above the 5% on that channel width when we had dipped all the way down to like 2.5%. So we've doubled the size of the candle with this breakout here to a new 4-week range. And you can see the entire value area of the 4-week range is in the lower half of the chart. So there's not a good margin of safety here. We're pretty tenuous. So you have a good shelf here from last week when we were so sideways there, kind of built up a little shelf up above this value area, but not much volume there in between, especially on you can see like the diamonds are really far up there, and there's IWM just barely breaking out of the value area today at the very end of the day today, closing above briefly last week's high point there, and we'll see if we can't build on that. Would be really nice if we can build on that. Remember the SPY. SPY, we got that one touch on the bearish candle, so it's probably going to take the rest of this week for the red line to get back to zero, and then again with the high point today, you'd have to go all week without into next week without a new high point to get the green line below 70 before you're threatening a jump up on the red line to 100, right? That would ideally be, if you're changing the trend, ideally be more than just one day. Remember, one day is whether these green one-day touches are pretty bearish, and these red one-day touches are pretty bullish, as we've seen here. So a nice, good continuation pattern of the bullish trend that we have. Let's take a look at today's volume. Again, a quiet day, but we have a lot on the plate. Here you can see today's range was a little bit above average thanks to this late push at the end of the day. It was very small, but the volume was very light down there at the bottom. As a result, the range is actually okay. It did dip below 0.8%, the average range at 0.798 over there on the right, and the volume again is kind of holding steady at relatively high levels, considering that the volume was a lot lower over here when the range was higher. So the range has been getting smaller and smaller, but the volume is actually staying pretty strong up there. If you take a look at the money flow on this, you can see again, remember we're way up above this peak, that we're not, we're pretty much at the same level, just a little bit higher here on the money flow itself, as we're sitting at, at a pretty similar peak that we were going into the very end of the year there on the money flow. The VIX was another thing, of course, we look at besides the ranges. You can see the VIX started the day higher, which is pretty much always does on Monday, but it didn't really jump above the 90% mark. And the VVIX, you notice, it did jump up above here to 83. So we had a little bit of a pop higher in the volatility, even though the market was higher. But again, it has to do with Monday versus Friday. And the VVIX ramped up, so your correlation is still pretty strong. But again, we'll see if that VVIX continues to move higher, because that generally means that that we should expect more volatility. As you can see, the volatility itself is not really at bullish levels. It's still up above its average values for the past, 30 days, 50 days, whatever. So we're not necessarily at bullish levels here from a risk appetite standpoint, from a volatility standpoint, even though now we're only maybe a few more days away from the 200-day average of the VIX dropping below this kind of pivotal 15 level. It hasn't done that. You have to go way back, multiple years back for that to happen. You briefly got below it here at the end of 2019 going into the COVID, very briefly, and it was very, hardly below 15 at all. And before that, it was 2017, where we were so, down there, so low. In fact, it got down below 11, the 200-day average. But needless to say, that was kind of an odd, again, coming off of an election and very bullish environment for corporations, for businesses, kept volatility down very low, 0% interest rates. We were raising rates very sporadically there. So much different environment there, the liquidity environment there than we have right now in the markets here in the first going into the rest of this calendar year. All right, if you take a look at the returns over the past 3 months, you can see it's now they pretty much caught up to each other. They're both IWM and the Qs are above 20%. The S&P is almost at 20%. I mean, again, these are strong 3-month returns. The dollar is down. That's been a big driver. Commodities is down. That's another big driver. And bonds are up, which means yields are down. That's been another big driver for a lot of this risk appetite. That's your three-headed monster, right? Risk aversion, at least the opposite is. And so bringing yields down has been a beneficiary, and that was the case today. Bonds are up over 1%, which means yields were down. Commodities were down, and the dollar underperformed all these other asset classes and was kind of flat at best, and really came down late, and that really propelled IWM up to almost 2% gains, the Qs over 1% gains, S&P over 3.25%. So very, very strong rally. If we take a look at at the ratio chart here of the Qs relative to IWM, you'll see that we've been dipping the past few days. The Qs have been dipping relative. In fact, it's been 3 days in a row now that IWM has outperformed. You can see the MACD rolling over, RSI dropping, DMI reversing down there, CCI dropping, RSI dropping as well up here. The correlation has been ramping back up, so probably not something we want to see. We don't necessarily want to see this continuing to drop. The number of stocks above their 50-day moving average are still at high levels, though below a very high moving average. That generally has not been the most bullish sign when this has dropped below its average, as you can see here, but so far so good in this case. But that doesn't mean that there hasn't been some fear in the markets, as you can see from the skew standpoint. We've traded multiple days. We were above 153 yesterday, 153.05. Today we're at 151. So anything above 150 is an extreme number for the skew, and so the markets are still really concerned about how bullish this is. If you look at like the dark pool index, generally that's kind of like an institutional way of purchasing. You can see that initially on a lot of this bullishness, there was a lot of buying on a lot of this early trends up to the upside. But as we've rallied up, the buying has really tapered off. Even the retail investor has not been up to new highs, as it kind of peaked over here. Both the dark index, dark pool index, and the retail investor right there on right around December the 13th, and especially right over here on January the 10th. They both peaked in those areas here. And then as the market's gone much higher from where we were on the 10th, both indexes have actually been coming down. So not necessarily the sign that we're really strongly bullish here from a breadth standpoint. The new highs and new lows index actually looks pretty decent. If I were to go back over here and take a look at the new highs and new lows index, of course the skew we already talked about. We'll take a look at the number of stocks above the 50-day moving average. The new highs and new lows you can see are still kind of right around positive 300. Again, not as strong as we were initially. At least it is positive, and at least it is above that moving average, which is right around the 20-day average, which is right around 60. So we were kind of flirting with being below it and some volatility here, but we jumped back up above it, and so far so good. Now we're not, above we're not at strong levels, 400, 600 plus area, but like I said, at least we are at least above, slightly above the moving average and above zero, and we'll see if we can't stay up there throughout the rest of this week. Again, like I said, very, very important week from a news standpoint of what could be driving the markets, from earnings to the Fed. I mean, the Fed should be laying the groundwork for what they're going to do at the March meeting, and that March meeting is on the table in terms of whether or not the Fed will raise rates. A lot of people, that at one point in time, the odds of a rate hike in March were up over 90%. And you can see as of right now, it's about a 55-45 proposition here. 45% chance they won't cut rates. And like I said, from a historical standpoint, as of the end of the year, it was over 90% odds that there was going to be a rate cut in March. So we've been gradually moving higher. This week, I think, will be the week that either breaks us up above 60 and gets us towards 100, or breaks us back down below 40 and gets us eventually to zero. I think it's ultimately going to go up to 100. That chart's going to go up to 100, so the odds of a rate cut will go to zero. And I think the market will start putting their eggs in this June basket. Right now, there is a 99.8% chance of at least one rate cut by June, and about an 88% chance of a second rate cut. Which would mean that if they don't cut in March, they most likely cut in May, and that's where those 88% chance odds are for a cut by May. But again, that would be kind of an in-between meeting. They usually do the projections in March and June, September and December. That's usually when they do their actions. So it would kind of go against their typical precedent. And like I said, the bond market still has not been pricing that in, as even the 3-month jumped up here and is still at the midpoint between. So the bond market itself still is not pricing in a rate cut yet, because it was such a drop. This is the effective Fed. This is essentially a proxy for the effective Fed funds rate. The 2-year note, you can see, is kind of flat over the past little bit after dropping as much as it did to price in those cuts. Same thing with the 10-year. Dropped all the way down well below 4%, down to almost 3 3/4 before jumping up to 4.13 before, and then dropping down today to 4.06 as you saw. So the question now is, is this a temporary, that big bullish move on TLT, is that a temporary move, or are we trending back up again? Well, as you can see, we're back up to the 17-day moving average. MACD and stochastics have turned up. Are we going to break up above that? As of right now, we haven't yet. The dollar, is it going to break back down? It doesn't look like it yet. It looks like it can be, but it doesn't look like it's broken back down yet. And of course, DBC, which is just breaking its 30-day with the potential filling up to at least the 50 and not the 200, still hasn't. And that a big part of that is what's going on with crude oil. It broke back down below the moving average and back to 77. Is this a one-day overbought decline, or is this the start of more of a protracted decline, which when those things are all in decline, that's typically been, at least not TLT but TNX, when it's back in decline, it's generally been bullish for risk appetite in general. I don't believe that's the case. I think today we've been so bullish over the past week or so that in all three of those things we've just had a little bit of a sell-off, or in the case of bonds, a little bit of an oversold rally. And the other two, more of an overbought sell-off, but I don't think anything necessarily trend changing yet. And I believe probably by the end of the week that will actually be higher on the 10-year yield, will be higher on commodities and crude oil, and be higher on the dollar index as well. To take a look at how the sectors are doing, it's not surprising to see that the hottest sector right now continues to be XLK. That's where Nvidia is, it's where Microsoft is. XLC is actually not doing too bad either. When you look at the rotation graph, you can see it continues to be mainly XLK, but XLC is, like I said, is showing some decent strength too. Here, let's go to the regular sectors ETFs and go to the daily chart here. And there we go. So here's the last 2 weeks. We'll fit that in. And there's XLK up to the right, XLC up to the right. Those are the only two sectors right now outpacing the broader market themselves. All the rest of the sectors have negative relative strength, and for that matter, negative momentum as well. So we're either all in or all out right now. It's kind of interesting to see the dynamic that's been playing out. Of course, when you do look at let's go at the top 10. We'll include Netflix and Adobe and Broadcom, since that's kind of part of the story too. You can see most everything except for Apple is in the top right, and Tesla down there in the bottom left. But Nvidia losing a lot of momentum here lately, and even Microsoft itself. Those are the two big drivers. It's starting to lose a little bit of momentum as well. And again, those have been the big drivers for a lot of this recent strength in the markets, right? If you were to come back over here and see this little breakout from that low point right there, it's been Nvidia and Microsoft, as you can see, were the ones that really jumped up to the right there. Boom, Adobe too, Adobe breaking out, Apple breaking out up to the right as well, and even Broadcom turning back around and moving up to the right. But it appears that we're starting to roll over a little bit. Meta's rolling over, Microsoft's rolling over, Adobe's starting to slow down, Apple's slowing down, Amazon's rolling over. They're all starting to slightly change. Nvidia, of course, and then of course Tesla way over there. So again, as this rotates down and to the left, you would presume that there'd be, that we'd be starting to run out of some of this bullish momentum there. The other thing I wanted to take a look at really quick was the major economies, all the biggest ETFs from a country standpoint. Let's take a look at the 12 grid here. Remember China, Japan, Germany, some of the biggest global economies out there. China not doing so well. It was actually down today 1%. Everything else is kind of doing okay, but Korea, you can see Italy, UK, Brazil. I mean, nothing is as strongly bullish as what we're seeing. Japan's trying to match it there, and Germany's up 17%. India's, of course, has been doing great relative to its emerging market peers. It's like the only emerging market doing well. When you look at the second, the next level of major markets that are out there, starting with Australia and Spain and Mexico over here. Again, you can see, we're not necessarily like getting these big numbers up to the upside, especially in the emerging market spaces. It's been mostly driven by India more than anything, and you can see some of the weakness in some of the developed spaces as well. So it's been a U.S. led move. If you look at the primary comparison chart here, there's China down at the bottom, but then there's U.S. up there with India at the top over the past 3 months, and that that's kind of the type of market we're in. There's where the mega caps are, and they're driving that, and that's why you'll see such a big jump. Like if you look at I've shown you before that the CAPE ratio is above 30. It's above 33 now, and then again this will be updated here at the end of the month, because this is based on a monthly chart. But going into January, again coming out of that parabolic move at the end of let's put in Brazil and China. Let's actually take in China and Korea. Well, we can put in Brazil and Korea because they're all right there. And then there's Europe, but let's put Japan in there along with Europe. You can see those two are right next to each other. And then there's the U.S., right? And there's the U.S., and then we'll put India in there because it's kind of matching the U.S. So that's going into the end of the year, and that will be even, as of right now, remember, it's actually about 33 on the U.S. At the end of January. So it continues to show some very, very strong relative strength and higher valuations, which are great while the momentum is still there. So we'll ride that momentum train while they're still there, but recognize that the significant margin of safety that these emerging markets have if things were to go south on a much broader level than what they already have gone on. And I mean, if you look at, like China on this, if I were to zoom out here and take a look at like a 5-year return on these major markets, there's S&P, and again on the 5-year return, there's India, but down here is China. You can see Brazil is down, Korea is down 6% over 5 years. So your emerging markets are just have a big margin of safety, and even S&P is just killing like France and Canada. There's Italy, Germany, the biggest European market. Japan's up 22%. So I mean, it really is an outlier and has really taken off here. Again, remember we are above these highs. But if I were to take a look at just from that January, or let's go from like January the 4th on of 2022. When we peaked, from that day forward, when we started to drop, again, Brazil is actually holding up pretty well, and there's India, and there's the S&P up 2%. China's is down 39% still. Brazil's down, Germany's down 11% still. Japan's barely getting back to break even after having been down over 25%. Korea's still down 22%. So again, that's kind of an out. The U.S. and then India in particular have been a little bit of an outlier here relative to the rest of their major peers. That brings us to our trade idea of the day, and I want to take a look at PDD Holdings, or Pinduoduo, Chinese company, having as you saw, 8% decline today, really breaking down below. It's producing a lot of breakout patterns here. There we go. The charts come up there. You can see the breakdown, right? The intermediate line having already crossed below market sentiment, but really breaking down. The near-term line coming down from a bearish high point, coming back below its intermediate line into bearish levels, down more than 10% below the moving average for the first time, well below all these other bull tags. So we got no bull tag here, but you can see the idea of what it is. The long-term chart, you can see the bearish pattern developing there, or the bearish decline, bigger bearish candlestick pattern than what we've seen for a while. Red arrow coming down from pretty decently high level on the gap, filling in the gap there between the 10-week and the 40-week exponential moving averages. You can also see breaking the 50, right, and the very poor margin of safety there. Big gap in volume because of that gap up on its last earnings, starting to fill that in. You can see how much how much room it has to go down towards its 200-day moving average, down towards that value area there. If you take a look at the Keltner channel, we also broke below both the lower band and the lower. This was just a couple of weeks after breaking above the upper band, but not the upper Keltner channel. But we did easily break the lower one. Still don't have green dots yet, but you can see the beginning of some bearish momentum down there. Of course, all these other oscillators are producing bearish breakout patterns. Big jump in the DMI as the ADX, which had been so bullish to the upside, is now turning back up now from a bearish standpoint. The RSI breaking below 40, CCI breaking below minus 200, so very strong bearish levels there, bearish breakout levels. The Ichimoku cloud, which had been strongly bullish, lost its bullish trend, its strong bullish trend, which was also above 14, and then now is the beginning stages of a new bearish trend as we are into the cloud with a negative rate of change. So you can see just how much this has turned south in a really big hurry. So what I decided to do there was say, okay, let's be a little bit aggressive and sell that 110, which is right where kind of that one standard deviation move is, but still above the value area and above the 200-day moving average. And then we'll buy the 115, so kind of a very low delta trade, very aggressive trade, very low risk, putting up about $500 to try to make $2,500. But because of the large reward, that puts that $500 in context, a very low risk trade relative to, say, a trade where I'm making $500 for a risk of $500. So Like the potential there, but again, very low probability. Low risk and low probability go hand in hand, just like high risk and high probability go hand in hand. But considering the technical patterns, we're willing to take a flyer on a stock like this in an area that's been vastly underperforming the U.S. markets, and you would expect would continue to underperform in either direction if risk appetite increases or decreases. You would expect this area, the world, to continue to underperform the markets until things drastically change over there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Click that thumbs up icon. Like our video. Comment on our video. Follow me on Twitter and Facebook. Join us and like us there. Join our website, of course, at marketscholars.com. Have a great rest of your Monday night, everybody, and we'll see you all next time.